Hi everyone, this is a short screencast for Independent Colleges Dublin for F6 taxation under the Irish syllabus for December 2014. In this particular screencast we're going to cover capital gains tax at a basic level, and particularly we're going to look at question 3 from the June 2014 paper for F6 IRE. So if we look at the requirements first, we have Clodagh and John, and we're asked to calculate their capital gains tax liability for 2013 for the initial and final periods. We're also asked to give any sort of explanation that we can for any of the items above that do not give rise to a capital gains tax liability for the year. Okay, so looking at the first part of the question here, we'll see that these two individuals are resident and domiciled in the state, and that effectively means that they'll be subject to capital gains tax on any transactions on a worldwide basis. Okay, and typically with the F6, we'll see that the various transactions that they have undertaken in the year will be just sort of listed in number format. That's the normal sort of format that the F6 examiner takes. Okay, so this first transaction they've made, it looks as if it relates to their principal private residence. Okay, and we should remember from our studies that a PPR can be exempt from capital gains tax, subject to a set of given parameters and rules. Okay, and we'll see within the answer to this particular section that a large proportion of this particular gain is in fact exempt. One other thing to remember about PPR is that certainly the first part of the calculation will be done as normal. So really we're looking for some form of three-liner. Proceeds less cost equals gain. In this particular case, the proceeds look to be clear. They also do mention that the area of the garden is less than 1 acre, and they're doing that for good reason. We should know that up to 1 acre would be included within the house and eligible for PPR relief. Okay, they've given us a couple of sets of sort of costs here, or possible costs. They've given us the original cost in July 1965, and they've also given it a cost for some reason as at April 1974 of 12. So we need to figure out which is the one that we're going to use within our three-liner within our answer. Okay. Further detail here, as you would expect, in relation to what's been happening during the period of ownership, and it looks as if the individuals have always lived in the property. I mean, that's a good sign. One thing to draw your attention to here is it looks as if part of the property for a particular period, January 80 through to December 2005, has been used for business purposes. So we need to think about how we can extract that element, because that will be fully chargeable to capital gains tax and not covered by the PPR provisions. Okay. Next point they give us here, really some income details in relation to a room that's been let to a student, and it's sort of a pretty straightforward rule there. We know that income would be subject to income tax. I guess it's just a question whether or not this particular piece of income impacts upon our PPR relief or not. Okay. Now the next few points, 2, 3, and 4, really all relate to rules in relation to chattels for capital gains tax purposes, and there's several rules there, and I'll show you how they work within the answer. In the first one here, part number 2, it looks as if we have a chattel of some kind that has been sold for a small amount, and indeed bought for a small amount. Okay, so that's one rule being tested. This point number 3 here, we have a sort of tea and coffee set, and it looks as if the item has been purchased for 3.2 and then fallen in value. So it looks as if that's a durable chattel with some sort of a loss being made. Okay. Number 4 here, same sort of thing, but although it looks as if we have a sale at €2,700 and a purchase at 2. So in this one we have a gain. So you'll see a loss here and a gain here, and then just another area here to see whether or not we can establish that we're very familiar with the durable chattel rules. Okay, so if we take a look at the answer now for this particular part, just one thing I want to draw your attention to is really the format first. So let me just take you through how they structure their answer. You'll see that very clearly for question 3 they lay out their title, and then as we move down the question they just deal with each individual asset in turn. Okay, and once they get to really the bottom of their answer, once they've dealt with each of the 4, you'll see that we've got a sort of a full summary here of the gains or indeed losses for each of the 4 assets. So really that's what you're looking to do, is to summarize your 3-liners in your workings page, proceeds less cost equals gain, and deal with any sort of quirky little rules, for example the chattel rules, and then come up with some sort of total taxable amounts. Now you'll notice that we've got 2 columns here because we should remember from our capital gains tax studies that payment for capital gains tax is split relative to when the disposal was made. So we've got obviously that first period, 1st of January to 30th of November, and then we've got the final month in the tax year with different payment dates obviously relevant to those. So really that's what they wanted you to do, and you've been able to pick up that from the date of disposals as shown within the question. Now given the fact that they're a married couple, we can just split the assets here, or indeed split the gains. You'll see that each of them has their own AE, and then they tax accordingly. So, aside from trying to get a fix on the key CGT rules within this particular question, do get a feel for how the examiner has structured his answer. Okay, so if we go to item number 1, which was the principal private residence, you can see that, as mentioned when we were looking through the question, this top part of the working, it really sort of works as you would expect. It's proceeds less cost equals gain. We're given the proceeds in the question. The market value at 6th of April 1974 is what's relevant. Remember that any values prior to that will not be relevant for capital gains tax purposes, and that's why you'll find that the examiner will always give you some sort of market value at 6th of April 1974, and indeed if he does, then that's the value that you need to use, assuming that the purchase took place before that date. Obviously with the market value we're indexing up from that date, giving us the 90k figure, and then you'll see it's a simple sort of a deduction there. Now the exempt element will be dealt with sort of down below. We're looking to take out of the normal gain of 359 anything that is exempt under the PPR rules to get the taxable gain, which we included our list down below. Okay, so where do we come up with this figure of 312k? Well, you'll see from the working here, the PPR Relief working, that the first thing that they do is they calculate the total period of ownership, and do bear in mind that that would be from the 6th of April 74. Anything prior to that would be irrelevant for a PPR calculation. So really that first 468 month figure, that should be easy enough to calculate, because really we're just going from sort of starting point through to point of disposal. Okay, so that's where we get the 468. Now this issue with regard to sort of business usage, how do we deal with that? And, sometimes the examiner can come at this from the perspective of that the individual asset, the PPR in this case, was used in its entirety. In other words, from point A of purchase through to point B at disposal at a particular percentage. And in that case, what we'd be looking to do is really take a percentage out of the gain figure calculated in the normal way. So perhaps 20% of the total gain was relevant to business, and therefore 20% of the total gain is fully chargeable and not eligible for PPR relief. But in this case, what he's done is he's given us only a period of time, so Jan 80 to December 2005, which is only a proportion of this 468 months. So really what we're required to do is get the number of years and then just use that percentage element of business use, as it were, and multiply that by the percentage number, and that will give us the 62 months. So in effect, that 62 months is the element that is non-qualifying in this particular case. So really what do we do then? Well, we say, well, if the 62 months is non-qualifying, then really the difference between 62 and the total number of months of 468 is what is going to be exempt for capital gains tax purposes. And really that's where they get their fraction of 406 divided by 468, which gives us the 312. Okay. In terms of the rent-a-room, that's really exempt under the rent-a-room provisions, and I guess the thing to note here is that that doesn't affect PPR in any way, shape or form. So I think probably the examiner was hoping or expecting one or two candidates to take off that 5% proportion from the gain, and you wouldn't in this case because it doesn't affect the PPR relief at all. Okay, so that's asset number one dealt with. We just look slightly down the page here. Asset number two, we had prints that are effectively exempt because of the fact that these sales proceeds were less than our figure of 2540, and that's just an absolute amount. So we're looking for, chattels, durable chattels being sold where the proceeds are less than 2540, and we would have got 1.5 marks for knowing that. So it's quite a lot of marks for just a fairly straightforward rule. Okay, asset number three was the tea and coffee set, and what we'll see in this particular case is that we have a loss, but what we're required to do under the chattel rules is to really deem the proceeds to be 2540. Okay, so we have that figure up here coming in again. So we have to, in effect, sort of restrict the loss, and you'll note that there is no indexation at all because of the indexation rules of creating or augmenting a loss. So in this particular case, we sort of have a restricted loss, as it were, of 660 as a result of deeming the proceeds to be 2540. Okay. Asset number four, again, similar sort of rules, but in this particular case with the painting, we're looking at a gain, and that was clear from the question set. We see that we have a gain of 700 euros. Now, in this particular case, where there's a gain that's relevant, we have to use what we call marginal relief. And really what that does is it requires us to allow for this 2540 element, or the difference between that and the proceeds, and really restrict, if necessary, the tax or the capital gains tax payable to 50% of the excess between the proceeds as shown by the question and the exemption limit. So what you'll see that they do here is they say, well, the difference is 160, 50% of that is 80, and therefore that element, i.e. the 80 euros, is in fact the tax payable rather than the tax based on the gain above. Okay, so in effect we're restricting the tax payable in this particular case. Okay, so really what we then have is a sort of a summary, as mentioned earlier, of each of the four assets. And again, as mentioned, what's your format here? Try and bring down your gains or losses for each of the assets disposed of. Obviously, we have one that's completely exempt here at 0. Okay. Again, you'll notice they split between the two periods, as it were, and we come up with 45k for Jan to November, and then 700 for December to 1st December to 31st December, notwithstanding the fact that up above we restricted the tax payable. Okay. So in terms of a summary, or how we get to a total tax figure, as it were, we're going to split between both individuals. They're married, but they both will have their AE. Okay, so we'll see that the figure here is just simply split between each individual, 22,725 and 22,726. Deduct the AEs, obviously, and then we have net taxable. We tax at 33%, as we know. That gives us a figure of 7k approximately. Now, that final period, just note that obviously we're not taxing this amount here. We're actually taxing the, in effect, the 160 that we calculated, and the difference was 80. So that's the value that we take into the comp. That's where this figure of 80 comes from. And then we just total these up to get to the overall liability. Okay, so that's essentially just a quick summary of that particular element of the question. We'll just have a quick look at part B for question 3 of June 2014. This is reasonably straightforward, but this one relates to a company making a disposal as opposed to an individual. So a couple of little differences there that you'll probably be aware of. In this particular case, we have a JP Limited, and in effect what we have is the disposal of this commercial property. And this was purchased in May 2001 for 200k 6K and then sold subsequently in July 2013 for 300 after auctioneer's fees of 15,000. So really what we're asked to do is just calculate the liability based on the information above and also state the due date. Okay, so just a thing to watch out for here, as just mentioned, is just the sort of subtle differences between excuse me, how gains are calculated and how tax is calculated for companies as opposed to individuals. So if we look at the answer for this particular one, we'll see that again we have a heading for part B, tax liability on 2013 gain. Okay, and what you'll see within this question is, again, you know, the three-liner proceeds less cost equals gain. It's very much laid out as we would expect. We know the proceeds as per the question. Auctioneer's fees, they're certainly deductible from the gross sales proceeds. And then all that we do within the cost element is just uplift the cost for the indexation factor. Now that gives us a figure of 67.6. Okay, and you'll see that we'll get, you know, 1 mark just for laying out some fairly simple information. Now here's where the slight twist comes. We've got to appreciate that for limited companies, what we have to do once we calculate the gain in the normal way is to really uplift the gain by this fraction and then tax at 12.5%. So you'll see in effect that within any sort of corporation tax computation, you'll see the gain calculated in the normal way and then this fraction applied. And you know, more often than not, if there's something that students get wrong in this area, is that they forget to uplift by this value. Okay, and the reason that we're uplifting at this value is that we can tax the gain at our normal corporation tax rate of 12.5%. Okay, so in effect what we have is an uplifted gain of 178,464, and then we simply apply 12.5%. So in effect the rate is 33% if you look at the multiples here. And in terms of the payment date, really two parts there. We've been including payments with the main screen corporation tax both on May 14 and also March 2015. Okay, so that's just a very quick basic summary of this particular question, and I hope it's been of help to you. Many thanks.